Imagine we are running a race. Same distance, same finish line, except I get to start 3 seconds before you. You would probably say that's unfair. But that's exactly what retail trading looks like. Most people think trading is about predicting prices. It isn't. It's about who gets there first. And here is the crazy part. The companies you are competing against aren't just faster than you. They are paying millions of dollars every year to start the race closer to the finish line. That sounds like a conspiracy theory, except it isn't. It's literally a service that stock exchanges openly sell. At first, I thought I wasn't just good enough for trading. Turns out, I was playing the wrong game. When you click buy, your order doesn't magically appear on the exchange. It travels from your computer, through your internet provider, through your broker, through multiple data centers until it finally reaches the exchange. That usually takes a few milliseconds. Doesn't sound like much until you realize the firms sitting inside the exchange aren't waiting milliseconds. They are measured in microseconds, roughly 1,000 times faster. Imagine entering a Formula One race on a bicycle. That's what trying to beat high frequency trading firms look like. And here is the part that blew my mind. These firms literally rent server racks inside the exchange building, not nearby, inside. Why? Because every extra meter of cable adds tiny amounts of delay, and in their world, being 1 microsecond slower can mean someone else gets the trade instead. So here is my question. Why was I trying to beat people at a game they built? When I first started trading, I did exactly what almost everyone does. I bought calls, I bought puts, I traded earnings, I chased momentum. Every thumbnail promised the same thing: 300% overnight, turn 500 into 5,000. This stock is about to explode. And honestly, I believed it. I kept struggling. I remember thinking, maybe I'm just terrible at options. Then one day, I stumbled onto a paper from MIT. I expected it to tell me I needed better technical analysis, better path patterns, better entries, better exits, but that's not what it said. The researchers looked at what retail traders actually do around earnings, and the results surprised me. On average, retail traders lost between 5 and 9%. During high volatile earnings, those losses reached 14%. But those numbers weren't the part that changed how I thought about trading. The reason behind them did. These traders don't lose money because they guessed the direction wrong. Many of them were right. The stock moved exactly the way they predicted, and they still lost money. Why? Because they paid too much for the option. Right after earnings, implied volatility collapsed and the option lost value, even though the prediction was right. Think about that for a second. You can correctly predict where the stock goes and still lose. That completely changed how I looked at buying options. But then I found something that bothered me even more. Another study, this time from the University of Florida. They looked at retail traders using complex options. The average loss 16.4% in just 3 days. Imagine losing 16% of your account every 3 days. Most traders won't survive very long. So I started asking myself, why is this happening? Was everyone simply making bad trades? Not exactly. There were hidden costs almost nobody talks about. Wide bid ask spreads, expensive implied volatility, transaction costs. They are not exciting. Nobody makes YouTube thumbnails about them. But over time, they quietly eat away your returns. That's when it finally clicked. Maybe I wasn't a bad trader. Maybe I was just standing on the wrong side of the trade. That realization changed everything. Instead of asking which option should I buy, I started asking who is selling it to me. Because every buyer needs a seller. And if the research keeps showing that retailers consistently overpay, maybe I shouldn't be the buyer, maybe I should be the seller. That's what eventually led me to premium selling. Now, let's be clear. This isn't a magic strategy. Selling options has real risk. One bad trade can wipe out months of gains if you ignore position sizing and risk management. But here is why I like it. I'm no longer trying to beat computers measured in microseconds. I'm playing a completely different game. Wall Street spent decades building a system where speed wins. So I stopped playing the speed game. I started playing the probability game instead. I have a normal 9 to 5 job. I don't have a room full of monitors. I don't have servers sitting inside the New York Stock Exchange. I don't have $1 billion algorithms competing on my behalf, but I don't need them because patience doesn't care how fast your internet is. Time doesn't care where your server is located. Probability doesn't care who got there first. So, is the market rigged? I don't think that's the right question. The better question is this: are you trying to win a game that has never designed for you? Remember the race we started with? You were never supposed to outrun a Formula One car on a bicycle. So stop entering that race. Find a different one. Once I stopped trying to beat Wall Street at speed and started building a strategy around patience and probability, trading finally started making sense. And that's exactly what this channel is about. No Lamborghinis, no fake screenshots, no 1000% gains. Just real trades, real money, real probabilities. You don't have to beat Wall Street. You just have to stop playing Wall Street's game.